Hello, everybody. Welcome back to Chapter 19. We're going to be looking at a different type of depreciation. Today, it is called double declining balance method. And this means that it's not going to be an even amount of depreciation, but it's going to be an even percentage. So it's going to be a little different. It's actually, I think this is easier than straight line, to be honest with you, but that's not why companies would use it. They use it because they feel that if they have an asset, that most of the depreciation that occurs within the life of an asset happens at the beginning of its life. And that's usually true because I just taught the credit unit in consumer. And I explained that, I remember talking about a car that depreciates more at the beginning of the life than the end of life. And we actually talked about that in the car buying unit as well. Um, so, to buy a car on credit when the depreciation occurs a lot at the beginning is not a really good investment. But we're talking about depreciation here. So the value of an asset does go down quite a bit in the beginning. And then it kind of levels off and it slows down a little bit. But there is a financial impact on that in regard to income, an income statement, and taxes paid. So depreciation, as you remember, is tax deductible because it's an expense. And expenses reduce taxable income. So if a company buys an asset and they're using double declining depreciation, that means that some of their income might be sheltered from this depreciation expense, more so in the beginning of the life of an asset than in the later years of owning the asset. Okay. So that's just a little abbreviation or a little explanation of what this method brings to a company. The equation that we're going to be using in our sheets is we're going to be starting with 100%. And so I know that looks a little weird, but you'll get used to it. I'm actually going to fix this a little bit. So 100%, and we're going to divide it by the years of life, and then we're going to multiply it by 2. So there is a declining balance of depreciation where it doesn't quite depreciate as much in the beginning, but a double declining rate really knocks it hard in the beginning. Another thing to remember as well when we're going through this is we're never going to depreciate below the estimated salvage value. And that was true also with straight line depreciation. Okay. All right. So let's go to our sheet and we're going to I actually started practicing a little bit before I jumped in. We're going to start with the problem, and I put the problem over here to refer to it while I'm teaching you. All right, so I'm gonna make it a little smaller so I don't have to scroll over. All right, this guy over here. All right, so the first problem is that we've got to depreciate this painting machine over the course of 4 years. So let's name the asset painting machine. Okay, the depreciation method is double declining balance method. And the original cost of this paint machine is $27,000. Cheap. Estimated salvage value is 1,000. So we're really going to use this right into the ground. And it looks like this estimated useful life for this painting machine is only 4 years. So we're just going to put 4 here so we can always cell reference easily. All right, so we're going to just pretend that it's like 2011. Okay. And so this is going to be depreciated over 4 years. So I'm going to select 2011, 2012, and then drag it down to the other 2. And we've got our 4 years that we're going to depreciate. All right, so this is going to start very similar to straight line depreciation. We're going to start with the beginning book value, which is the cost how much we actually paid for this machine. So the cost of the machine. So let's cell reference the 2,700 or 27,000, excuse me. And now we're going to be putting in our equation. Okay, so we're going to start with an equal sign as we always do. Let's put a parentheses in, and we're going to type in 100%. And we're going to divide it by 4 or B6. Okay. And then we will actually, you know what? I'm not going to do that. I'm just going to put 4. And then we're going to multiply it by 2. And you're going to see why I did that. I'm not going to, because I would have to actually put an absolute in there, and I could if I wanted to, but we can just use 4. And we're going to hit enter, and we got a declining balance rate of 50%. So this tells me that in the first life of owning this painting machine, that this thing's going to reduce in value by half. It's quite a bit, right? So we're going to get that by multiplying the annual depreciation, 27,000 times 50%, 13,500. You know what to do with this book value. What do we do? What do we do? We go equals and 27,000 minus the 13,500. That gives us an ending book value of 13,500. Let's go to the next year. Cell reference. And we're just going to copy this formula down. Okay. And actually, we can probably just copy this, these two down as well. Let's just copy these. There we go. Okay. So what this means is we took that ending book value and we multiplied it again times the 50%, and that gives us an annual depreciation of 6,750. So you can see how the first year you took a big hit. It's getting smaller, which is good. And I think what we could do is probably just take all of this and copy it right down here. And now we've got to do something a little different. So up to year 3, we're good. It's pretty much the same procedure every year. However, we've got this $1,000 salvage value that will be taken into account. And chances are we did not estimate that perfectly with our declining balance rate. Okay. So what we're going to do is we're actually going to, and the ending book value, we're going to put as $1,000 because this thing it's either going to be $1,000 or it's going to be 4 years. So this painting machine cannot be depreciated past 4 years. So we know that at the end of the 4th year of owning this machine, that it's going to have $1,000 value. All right. So we're just going to kind of work backwards here because, well, first of all, we can copy this down here because our beginning book value is our ending book value, right? And so the annual depreciation for the final year is going to be the difference between the book value and the ending book value, which is actually salvage value. So equals 3,375 minus $1,000 equals that. And we're going to leave this blank. That doesn't need a value. So we'll just gray it out. I'm going to gray it out because it doesn't have a value. Okay. So let's move on to the next one. See if we can do this. Again, we've got an office computer. Type office computer. Depreciation method is, actually, I'm going to cell reference that. I'll have to type it again. And the original cost of this office computer is a little lower, $2,200. The estimated salvage value is $200. It says right here, estimated salvage value. And the number of years of useful life, it says, is 5. There we go. All right. So for this year, we're going to say year 2000. Let's go in the future. 2021, 2022. Okay. And we are going to depreciate this for 5 years because that's what it says. We have to depreciate for 5 years because it only has a useful life for 5 years. And then we'll stop depreciating and close it out. All right, so the beginning book value is the same. as the original cost. So we can just cell reference that. The declining balance rate is, once again, start with an equals, parentheses, 100% divided by the estimated useful life, 5. Okay, typically that would give you 20%, but we multiply it by 2. When it's double declining, we multiply by 2, and that's what we're learning in this chapter is the double declining only. Okay, so we've got a 40% declining balance rate. All right, so we're going to do the same thing again. We're going to multiply the beginning book value times the declining balance rate. That gives us $880 for the first year of depreciation. The ending book value is equals the book value minus the annual depreciation. Okay, you know what to do here. So reference the ending book value comes to the beginning, and we are just going to bring this down like that because it's the same formulas, and we're going to do it again twice. There we go. All right, so we can see that we're getting really close to the salvage value, right? So it looks like our last year of annual depreciation is not going to be that much. We're going to cell reference the salvage value for the end of the 5th year, and we're going to work backwards again. Okay, we know that the beginning book value is $285.12. So the annual depreciation is going to be the difference between the two. I think this is easier than straight line, personally. I do. I like double declining. All right, so now we're done with the office computer. So we can estimate what our expenses will be in regard to depreciation. If we got this asset, we could do this work ahead of time and say, oh yeah, at the end of 5 years, we can get rid of it for $200. But you know what? Anything could happen. Like we might see that our ending book value is $475 and someone wants to buy it from us for $800. Well, we'd have to make a decision. Would we want to sell it and get more than what it's worth, or do we want to get a couple more years of useful life out of it? So those are decisions that companies would have to make. All right, the last one is the plant asset, the sander, good old sander. All right, then we've got a depreciation method, same thing. I'm going to cell reference because we can cell reference text. There we go. All right, the original cost is $800. The salvage value is 80, and the years of useful life is 8. Perfect. All right, year 1. So should we go, let's do 2011. Let's just be different. 2012. And then let's select those two and then drag it down for our years. Remember, if we selected one, what would it do? It would just bring down to this 2011, right? So if you select 2, it's so smart that it knows it's a date and it will continue on with the dates. Okay. All right. Beginning book value. Let's do this. You got it now. $800. This should be easy now. Equals, parentheses, 100% divided by what number? You got it. 8. Nice. Hi. Don't forget your times 2. Double declining. Enter. All right. Annual depreciation is 800 times the 0.2 gives us 200. Book value is, actually, you know what? I'm going to see if that works. It did. Yep. So what I did, no, that did not work. Nope. Forget I did that. All right. Equals 800 minus, I was trying to be fancy. Nope. Didn't work. All right. 600. There we go. The beginning book value is last year's ending book value, $600. And we're going to take this, and now I'm going to get fancy, and we'll bring it down. All right. Now what are you going to do? We're just going to copy this down till we hit the 7th year. We get to 106 because we're getting real close to that 80 mark, right? So at the end of the 8th year, we can only depreciate up to 8 years or up to when the salvage value is 80. So let's pretend, just for argument's sake, let's pretend this was 75, right? We couldn't go another 8, couldn't go to 8 years. We would not have estimated correctly. All right, so we know we've got some life left. This is still worth more than the salvage value. So what we're going to do is cell reference, and then once again, work backwards. All right, so we'll take this down, last year's ending balance, and actually, I can copy that. Did that work? No, it did not. No, it did not. No, I can't do that. I have to take the difference. Okay. See, these are mistakes that my students sometimes make, and I go right with them sometimes. Okay, so we know we cannot copy that formula, okay? It's different because we're not using the percentage, so it's different. We cannot do that, so don't make that mistake that I just made, okay? Okay, so that's it for double declining depreciation. I think I'm gonna give you guys a little break today. That's it. I'd like you to read just a couple pages of double declining depreciation, just kind of wrap your head around what it is again. And I think we're gonna skip the application and we're gonna do the mastery, but we're not going to do that until I think next week, possibly. Well, I might start it on Thursday, I think, because on Thursday I'll do 9-6 with you, and then I'll have you guys do the mastery for Thursday as well. Because 9-6, this will take like 5 minutes. This will take long at all. So you guys can do the mastery on Thursday, and then we're going to do the study guide. I think on next week on Monday, I think it is, and then we're going to have a little quiz on depreciation. All right, so that's all happening next week. But anyway, I will be back and be talking to you on Thursday. All right, have a good week, you guys. Take care.